20 years ago, nobody knew about private equity. People who couldn't get into hedge funds where the money was went into the unglamorous, ignored industry. Changes in rules, investor preferences and cash have grown the business 20 times since then. In 2000, it created hundreds of billionaires, purchased millions of businesses, had a poor reputation, and grew too huge. Private equity's modest operations made it competitive, but it's outgrown its host like a parasite. Private equity ventures are difficult to find, fees are harder to justify, and earnings are not worth the risk, its largest threat. This may bother wealthy investors and asset managers, but the system relies on borrowing a lot of money through corporate structures like this, and expecting growth would continue forever. If not, trillions in loans could go bad, causing you problems. What happens in New York City if private equity is a bad investment? Who keeps handing them cash? As a financier, what's private equity? What was your highest annual income? $500,000. $500,000. Private equity-owned companies fail more. Red Lobster's bankruptcy isn't because shrimp glut. The Red Lobster's private equity is problematic. That can't continue. You know why? The US debt ratio is unsustainable. Private equity operations in brief. Private equity is any investment in private companies or assets. Investment in a small bistro for $1,000 is private equity. Dedicated private equity funds that buy entire businesses with high-profile investor money bring all the sleeveless vest lads to the yard. Buyout funds, private equity firms, take their investors' money, invest a little, and borrow the rest to fund purchases. They persuade real companies with real products and cash flows to take out huge loans to pay back a special dividend after buying a portfolio. The founders of these companies can own billions with a minimal investment. Still more. The private equity firm isn't accountable for portfolio firm loans. It begins and ends with firms. Like Walmart, shareholders aren't accountable for debts. You only lose your money if your shares drop to zero without a return. Private equity can secure a bank loan with a vast portfolio of private companies. These net asset value loans are nicknamed leverage on leverage or leverage squared because they're taken out against firms having loans. The debt continues. Remember the startup capital from wealthy investors and private equity partners. Wealthy investors can borrow money to invest in these companies tax efficiently. It gets worse. Private equity isn't publicly traded, which is disadvantageous. When they need cash, investors may have problems selling corporate ownership. Thank goodness secondary funds buy private equity. Contrary to regulations, secondary funds can use loans to buy. Their purchases are mostly debt-financed. If you're keeping track, they'll take on debt to buy a stake in a firm originally purchased with debt that was used as a down payment on more debt to buy a business that took on debt to deliver paper returns to a fund that used those returns to qualify for more debt to buy more companies that could take on debt. It's not everything. This form of lending is profitable, so not just banks do it. Some private equity firms lend money to private companies and PE firms, not buy them. They lend to private companies without reporting and are not banks. Where private credit organizations derive their money to lend is unknown, making data collection difficult. It is. Borrow it. Private equity has scaled so quickly and earned so much for all of these organizations' employees because of this ongoing cycle of leverage on leverage on leverage, but it still had to come from somewhere. And statistically, it's you. We must calculate how many works to determine what happens when this debt collapses. The other way. Long-term market gains are practically unbeatable, say investment experts. Warren Buffett and Jim Simons invented new investing approaches, yet countless backdated study has revealed the same result. Most market-beating investment managers were lucky. Lucky funds generally outperform and underperform future years. This practice may be worse than gambling because it destroys wealth quickly. Cathie Wood's ARK Innovation Fund profited greatly from one of the most hyped stocks. Her 2020 performance was excellent. Several investors acquired the fund before it lost 70% of its value and has delivered poor returns. Since 2014, the fund has returned 200%, close to the S&P's 226%. Most ARK investors bought in 2014 peak hype, not 2014. The fund survived. Most investors lost a lot. Active investment managers charge fees, which puts them statistically behind a passive, diversified, low-cost index fund over time. Private equity funds charge 5-10 times more than actively managed funds, therefore they would fall further behind in an efficient market. The wealthy and institutional investors that fund private equity managers recognize this. The research is decades old and respected. Who heavily funds private equity? Private equity was first great. Many of you are typing furiously in the comments because private equity has become a destructive monolith. But investors didn't start off that way. It was unattached to the market and may beat it. Because it didn't deal with listed firms, private equity didn't have to fight with Wall Street nerds with Penn Mathematics PhDs for 3 basis points of alpha. Instead, It invested in smaller local businesses and created value by merging their commercial experience with the prior owners. Many skilled small business owners lack professional business training, thus they don't optimize marketing, accounting, tax management, or expansion. Finance bros didn't want to set up bookkeeping software for a regional plumbing company in Ohio, instead of working on glamorous Manhattan high-rise deals. But private equity management teams could find these businesses, improve them, and maximize the returns of good, honest businesses to beat the market consistently. This space was more appealing than top investment banks or hedge funds, since people could make a lot of money and charge high fees. The situation is shifting for 3 reasons. The prominence of private equity has made it harder to find good businesses to buy. Small business owners had problems selling their businesses in the early days of the sector because few had the funds and skills to run HVAC or mechanic shops. Private equity firms frequently buy business for 2 to 3 times its annual earnings, so even without upgrades, they might profit from operations. As more firms entered the game, sellers had more offers, prompting new PE firms to bid higher for companies. First Page Sage, an industry research firm, says the average HVAC company sells for 5–10 times its earnings. Private equity business sales aren't obliged to be disclosed, making data hard to get. Even with rough estimates based on network feedback, expert interviews, and internal databases, a business that pays 10 years to cover its purchase price no longer beats the market after fees and expenses, so private equity firms had to push their portfolio companies harder to squeeze out more profit and flip them for big capital gains. A creative strategy in a rising market made this work for a while. After enhancing acquired companies, private equity firms may sell them profitably. Other private equity firms bought the most private equity-sold enterprises because new firms were paying more for acquisitions every year. Because they pushed their market, returns were high. Strong returns attracted more investment and allowed private equity firms to take on more debt and buy more businesses, raising prices and enhancing early investor returns. This modest feedback loop created big benefits and made long-term risks someone else's problem. It fostered the second problem. When organizations ran out of strong, stable businesses with solid cash flows to purchase, they had to go for riskier possibilities, which either meant paying more for stable businesses or seeking doubtful businesses in dangerous industries. It didn't matter because selling them was the purpose. For instance, private equity firms may control your favorite YouTube channels. YouTube channels are riskier than 3-generation woodworking shops, but can succeed. The race to locate additional businesses will raise these risks. Another concern is feedback loop reversal. The last 2 decades have favored private equity growth. Very low interest rates. There were several corporations that wanted a stock market alternative to real estate, but that's changing. Baby boomers are retiring in record numbers, refilling the market. Smarter small business entrepreneurs than 20 years ago. Wharton private equity alumni have less chance to make significant changes because everything about running a firm is online. Finally, industry doubts are rising. New private equity investments plunged 35% this year as investors understood how difficult it is to withdraw. 2025 may be the lowest private equity fundraising year in decade. Private companies' valuations are unknown until they're sold, unlike public equities. This allows private equity managers to sell profitable businesses and keep failing ones. Realizing future gains and hiding unrealized losses makes fund performance look wonderful, but the portfolio fills with terrible underperforming companies, which can only be disguised so long. If enough investors leave, private equity firms will lose their principal buyers. Secondary businesses are thriving. A discount was paid for private equity investors' assets to offer liquidity. Endowment-rich colleges are leaving private equity in record numbers. To raise money, Harvard is selling its private equity investment to anyone who will buy it. If new investors may buy discounted shares and companies from panic sellers, a new fund without a discount is pointless. That should be fine. For now, enterprises may focus on portfolio business development and accept lower profits. That massive debt is the only issue. Private equity firms must flip businesses to pay lenders, and if nobody buys, that might be a problem. Positive news. One private credit specialization is performing well. With nearly $21 billion in emergency loans to failing companies, distressed debt methods had their best year ever. Good news. Bad loans will cost Main Street banks, pension funds, and everyday people trillions if this system fails. This debt was securitized and sold as tranche bonds with differing risk ratings. By stacking debt, private credit organizations might issue low-risk, low-return, and high-risk, high-return bonds from the same lender. Rich fund managers and investors intentionally use plenty of debt to avoid. Actually invest that much of their own money to receive substantial returns when things are good, but they don't lose much if things go wrong. Although not as structural as mortgage-backed securities in 2008, a poorly managed PE collapse could hurt small businesses like the subprime mortgage crisis hit real estate. But there is more. Just private equity financial concerns. Too bad it worsens. If you liked the video, don't forget to give it a like and subscribe to the channel.